Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And markets are in a very similar position as they were about a week ago. We really have not seen a lot of movement here in the broader equity markets. Many of the concerns that we have brought up here over the past few weeks, we continue to see. So let's go ahead and discuss what those things are. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by taking a look at the broader equity indices and seeing where they currently sit, what concerns we continue to see from these equity markets, some of the volatility indices as well. We'll take a look at fixed income, where it has moved, what trends we're currently seeing emerge here from the fixed income markets that may also impact our views here on commodities. We'll take a look at the sector rotation model. We'll take a look at which sectors are outperforming the markets, which sectors are underperforming the markets. Right now, there are very few sectors outperforming the markets. There are a lot of sectors underperforming the markets. So it's important to understand which sectors are strong, which sectors are weak. We'll take a look at some of the economic indicators, including inflation, manufacturing, as well as financial conditions, before sharing with you some of our ideas and how we're thinking about the current market conditions. But the primary question that I want to help investors answer from today's session is an understanding as to whether or not the Chinese crackdown on technology companies have this provided an opportunity for us here in the broader markets. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my technical research, my economic research, and how I'm viewing the current market conditions to find potential opportunities. So let's start off with the S&P 500, or the major indices. And we remain in the very strong uptrend on the S&P 500, whether you look at the daily or weekly chart here. Over the past week or so, the equity markets have made zero progress. Basically, we have gone flat. We're trading within a very tight range on the S&P between 436 or so and 440, a little of 440 or so, 442 or so. So very tight range that the equity markets have been trading in. The one thing I do want to point out here is over the past few weeks, as equity markets pushed higher here, momentum is no longer confirming those new highs. So higher highs in price, lower highs in momentum. That is showing us that momentum is losing, we're losing momentum. There's signs of exhaustion here. But that in itself doesn't mean that you should go out there and short the markets. We're still very much in this upward trend. We're just simply near the top end of the range. Very likely, many times this resolves itself by getting towards the bottom of the range before it can continue moving higher here. If we do break this support level, this trend line, that's when things start to shift. We're not there yet, but this is some of the things that we're paying attention to. But at the moment, we're near the top end of the range. Just from a timing perspective, adding new positions in this type of market condition, in my opinion, is not a particularly great timing when you're near the top end of the range and you're starting to see both negative divergence and exhaustion here from the broader markets. You see that on the S&P, and you also see that on the Nasdaq 100. Higher, strong uptrend here, and there's no doubt about the uptrend here, but very much near the top end of the range in terms of that uptrend. And again, same thing as you make higher highs in price, no longer seeing higher highs in momentum, showing us that divergence. Whether you look at this on the daily chart or the weekly chart here on the Nasdaq 100, we've seen this weekly divergence happening for quite some time. This is weekly divergence that's been going on for a very long amount of time here on the Nasdaq 100, and then also on the daily time frame. We're seeing this in the short run here as well. So these are some of the things to pay attention to from a short-term timing perspective. Is now the time to add on to new positions, or is now the time to be more defensive? When you see these times of exhaustion, when you start to see momentum turning around, those are times to be more defensive, especially when they're coupled with other market indices such as the Russell 2000 showing the same type of weakness. So if we look at the Russell 2000, what's interesting about the small cap index is that it's made no progress since February. January. The Russell 2000 was at 222 in February. It is back at 222 today. So over the past 6 months or so, the Russell 2000 has made zero progress. You don't necessarily typically see the S&P, the Nasdaq make brand new highs month after month, and the small cap index not keeping pace, at least, or confirming those new highs. So this shows a lack of participation across the board, meaning you have a few market cap, very large market cap stocks making brand new highs while most of the market is not keeping pace. You also see it by looking at the Dow Jones. As you can see, Dow Jones made a high here in early May, and we basically have made no progress since then. And so far, multiple attempts to break out higher here over the past couple of weeks have failed, and we're seeing more of a rejection here and kind of more of a perhaps a resumption back towards the lower end of the channel before it can continue moving higher. But notice same thing. We see the same issue with the Dow as we make higher highs in price, no longer confirm higher highs in momentum on the daily and weekly charts. So these types of exhaustion signals, they're not just across one or two market indices, they're across almost all of them, and including RSP, the equal weight S&P 500. This is also telling. The fact that the equal weight index since May 5th has not been able to make a new high. And we're seeing the same levels of exhaustion here on the equal weight indices as well. So this is all telling that the current health of the market rally is not particularly strong. This is not new. This is something that we've been pointing out here for the past 5 or 6 weeks or so. And pretty much since then, we've made very little progress here in equities for the most part, or most equities that you track have made almost no progress. You have a few major market cap mega cap stocks that have made some progress, that have dragged the S&P and the Nasdaq 100 higher, but for the most part, the broader market has not participated in this. And this is another chart to show you the number of stocks trading above its 50-day moving average is currently at 37%. Remember, the S&P and the Nasdaq are at all-time highs. Does it, when you see this type of number, that only 37% of stocks are trading above its 50-day moving average, that does not instill confidence that the current all-time highs is sustainable and will likely continue when the vast majority of stocks have not participated on this rally. But I will say again, and I have said this week after week, is that these conditions, while concerning in terms of the health of this market rally, in itself is not a good reason to short the markets. And if the indicators that I'm showing you here today, they have existed 5 weeks ago. If you went out there and shorted the markets, you would have lost money on the trade. So just because you have these conditions, that's not a signal to go out there and short the markets. You need to see a catalyst. You need to see price action actually accelerate to the downside. And that's the only thing that we're missing from this. And that does not mean that things can't improve, meaning we can start to see stocks participate. We can start to see sector rotation. We can start to see the stocks that have missed out, small caps, equal weight, mid cap, start to participate on this rally, and the health of the market rally improve, and for the markets to continue. So this doesn't have to resolve itself in some kind of spectacular market sell-off. So I want to be very clear for investors who look at this data, or perhaps if you're a first-time viewer looking at this thinking that you need to go out there and short the markets, and that's not the case. But this is something that is evolving week to week, and this is something that we are continuing to pay attention to and inform you as to what we're seeing here in the broader markets. But what we're seeing here, and in addition to what we're seeing here from the volatility indices, is that the markets have been pricing in higher volatilities over the past 3 weeks or so. So as equity markets have continued to push new highs, volatility such as VIX or VolQ continues to climb. So VIX is now trading at around 19 or so. This simply means that we have higher amounts of implied volatility. So for option selling strategies like cover calls, cash secured puts, credit spreads, these are the types of better conditions for those types of strategies. So and it also instills a bit of, I would say, fear in the markets, if you will, that over the past few weeks, as markets made new highs, volatility indices continue to climb. So these are some of the things that we want to pay attention to. And the 10-year yield is certainly one place that a lot of investors continue to pay attention to. For quite some time, we found a bit of equilibrium here around 125 or so, On Friday, we saw a bit of a decline here down into the 120 range. So right now, it seems like the 120 range is the bottom end of the range. We'll have to see if this continues to find equilibrium around this 125 range, or if it starts to, or if yields start to decline even further. And when we look at TLT, when we look at the bond ETF, this is really where we see TLT on a very strong uptrend here. And we've managed to fill this gap twice and managed to break out higher here. So this, at least for me, when I look at TLT, seems to indicate that we could very well head back into the 155 range here to the upside, or test this, at least this 153 high that we had from a couple of weeks ago. So this certainly points to me that yields could potentially still go a little bit lower here. And then we do have this one final gap fill here on TLT, 155, just shy of 156, that has remained to be filled. And we very well may see a return back to this 156 level here before yields kind of find that kind of bottom, if you will. So these are some of the levels that we're paying attention to here on bonds that are important to pay attention to. And then just a quick rundown here on Bitcoin. We've talked about here the other day, Bitcoin stuck between this 30,000 and 40,000 range. And so far, despite a quick potential breakout here above 40,000, it did not hold. We're back into this range. So as of right now, Bitcoin is still very much in this 30,000, 40,000 range. Could very well see another retest here of 30,000 here or so, but we'll have to see if it manages to bounce off of this 21-day moving average and make another crack above 40,000. Then we could potentially say that Bitcoin has found a bit of a bottoming formation here and is ready to resume its uptrend. We're just not quite there yet at the moment. When we look at the sector rotation data, this is really where, again, the current market conditions does not instill a lot of confidence in this market rally here at the moment. We really don't see a lot of rotation. We really see a lack of rotation, and we really only see a couple of sectors continuing to show some outperformance here. You have healthcare, which is really the only sector that's leading. You do have a couple of leading sectors that are clearly weakening, such as utilities, staples. You have healthcare that's still in, discretionary, that's still in the lagging. Technology that's in weakening. You have communications that's improving. You have industrials that is weakening. You have financials weakening. The material's certainly moving in the right direction here, but we're starting to see some reversals there. Energy making a big move here to the upside, but that's because it was coming from such a bad position to begin with. I don't necessarily see energy going into the leading category anytime soon. Look at how far away it is from that. So this is something that we're paying attention to. And real estate was leading, but starting to lag behind a little bit. So these are some of the signs that we are not seeing a lot of healthy market rotation. In a healthy market rotation, we should see 4 or 5 sectors that are improving, 4 or 5 sectors that are weakening. We're just not quite seeing that. We're not seeing any real sectors continuing to gather strength or weakening, or vice versa. So I do want to point out only 2 sectors at the moment are outperforming the broader markets. So out of 11 sectors, 2 are outperforming the broader markets, 9 are underperforming the broader markets. That, again, is not a ratio that's particularly healthy for the market rally. And you really have healthcare that has continued to be on this very strong uptrend here. As you can see, pretty much since the beginning of the pandemic, healthcare has been a very strong sector and very steady sector, I would say. I will say what's interesting about healthcare is that it hasn't started to break out above its trend. So it's actually accelerating that trend, something we don't see very often, at least from the sector ETFs here. So healthcare outperforming the broader markets, and also real estate. The only 2 sectors at the moment that is outperforming the equity markets. Now, real estate, I will say, has suffered some of the same issues that we're starting to see in the major indices, higher highs in price, no longer being confirmed by higher highs in momentum. That is concerning to the speed at which real estate is outperforming the market, but it is still one of the only sectors at the moment that is outperforming the broader markets. So these are the things that we're paying attention to here right now, and we'll continue to update you here week to week as to how things are progressing. Now, when we take a look at the inflation data, this is really where we continue to see inflation data surprise here to the upside. This is based on higher frequency inflation data. The city inflation surprise index continues to climb. So, over the past couple of months, we've been talking about transitory versus permanent inflation. It seems like the market has kind of moved off of that in terms of feeling that that debate has been settled, that the concerns around inflation is largely transitory. And I would say that most participants in the market generally agree with that statement, but the short-term indicators continue to show a fairly strong amount of inflation. And this is something that we're really looking to see this taper off here in order for the the loose financial conditions that we are in terms of monetary policy to stay loose as where they are. One of the major concerns about tightening of financial conditions, of raising interest rates, is tied to inflation. Our concerns around that inflation starts to get out of hand. We're going to have to raise interest rates to help to tame that, if you will. At the moment, right now, one of the major, I would say, drivers of equity valuations to continue near where they are and continue to get stretched is the fact that financial conditions are extremely loose. One of the things that you can do with the financial conditions index is to chart an inverse of it, and they have a very high correlation with equity returns. Basically, the looser the financial conditions, the higher equities will continue to climb. And then once you have tightening of financial conditions, that's when you generally tend to see a market top. So these two charts are ones that are important to pay attention to, because if this continues to climb, this really puts on more pressure for the Fed to raise interest rates perhaps a little sooner than expected. And that is likely the type of catalyst that could drive equity valuations and equity markets lower. So important to pay attention to. And then when we look at manufacturing data, one of the things that we did see is the recent survey here for July did come out a little weaker than expected, 59.5 versus 61, but it is still fairly elevated here. So we're seeing a bit of contraction here in manufacturing. I will say that this still, again, remains at fairly elevated levels. So this is still conducive to the economic recovery that we are in. And likely, as we start to see some of the easing of supply chain, as we start to see companies build back inventory, we very well could see manufacturing spike up again to the upside. And also we're starting to see a bit of easing, if you will, on the prices paid for manufacturers. So this is showing us some of the inflation and some of the supply strain, if you will, supply chain strain that we currently see in the broader markets. There are some signs over the past couple of months that they are starting to ease. In my opinion, it hasn't eased enough. These are still pretty high numbers here, but it is starting to peak, and that's really more important, unlike this inflation index that we were just looking at on the earlier slide. So these are some of the things that we really want to pay attention to. So when we look for ideas here in the broader markets, it's tough to find ideas in markets when they're trading at all-time highs, and you're kind of stuck between a rock and a hard place with respect to, that equity markets are exhausted. So, pushing brand new long positions here in this broader markets, the timing on that isn't particularly great. Trying to find shorts in this market is also not particularly easy, because of the fact that we are very much in a strong bullish market, and we haven't seen any catalyst. We haven't seen any strong evidence that there's going to be, a big downside move here in equities. So how do you look for opportunities here in this broader markets? Well, this is really where kind of the, I would say, crackdown that we've seen here in China over the past few months, and especially that's accelerated a bit over the past couple of weeks, may provide some opportunities as you think about this type of market. Now, these are a little bit more speculative in nature, but these are the types of opportunities that you may be able to find here, or the stronger opportunities that you may be able to find in this type of market condition. So Alibaba is a stock that we have, largely stayed away from a long time. Alibaba has largely been a huge underperformer here since the last year after the crackdown here from Alipay, or the attempt to list Alipay as a financial institution here in China. But I will say that what we have seen over the past week or so does look like it's a bit of a capitulation here to the downside. And I think Alibaba is starting to, get out of the crosshairs of the Chinese government and some of the other, education type technologies, gaming technologies, which is really kind of where the Chinese government is currently focusing their attention on, away from e-commerce, which, largely is still a strong business here from the broader markets. I think Alibaba is worth paying attention to here right now, especially after the recent breakdown here up below 200 here or so. You have this weekly candle that looks fairly constructive here. Just below the 200-week moving average. You have what we call some positive divergence here, where we're making a lower low in price, but momentum is no longer confirming these lows. Basically, the inverse of what we're currently seeing from equity markets right now, where we make higher highs but lower highs in momentum. Here, we're making lower lows in price, higher lows in momentum. So this leads us to believe that there is some exhaustion, if you will, to the downside, and this could potentially provide some opportunities here to the upside. So whenever it's always tough to figure out where the exact bottom is on a stock, right? Because you could have also potentially called the bottom down here. You did get a nice rally, a short-lived rally, if you will, and then it continued to move lower here. But we're starting to reach a similar type pattern here, where you have kind of a island reversal bottom here, some positive divergence, and the potential opportunity for Alibaba, which is now above 200 again, to potentially start to rally, or at least find a bit of a bottom here. So those are some of the ways that you can start to look for opportunities. And not to mention, we're basically back to 2018 pricing. In terms of Alibaba, if you go back a little further, we're back to the same price that Alibaba traded in 2018, and when revenues and earnings were half of what they are right now. So if 2018 valuations for Baba was, maybe a little bit too rich, now we're trading at half the valuation that was trading in 2018. So for those reasons, I do think that it's warranted. It does warrant a second look here at the moment for Alibaba. The second industry that I want to take a look at here are Chinese industries that the Chinese government are backing, if you will. And this is really in the semiconductor space, in the autonomous driving space, anything where they are trying to leapfrog the Western technologies, if you will. And autonomous driving is certainly one of those. And one of the main, I would say, providers of this here in China right now is XPeng, which is one of the leaders, I would say, in electric vehicles with respect to their building of autonomous driving. And there's a pretty, I would say, huge intellectual property fight between Tesla and XPeng with respect to what technology they need to use to drive autonomous driving. XPeng using LiDAR and Tesla using cameras. And one thing that is potentially interesting here is that you've had the strong rally here from about 22.5 to about 42.5, if you will. We've consolidated for quite some time here for the past couple of months, and we're just starting to break out here. This would certainly project us back towards the $60 level that we had back here in February or so. So certainly, I think timing perspective, and just from a fundamental and government support perspective, looking at industries that the Chinese government does support, may be an interesting place to look, as you're going to see a lot of money shift out of these education companies, gaming companies, basically companies that the Chinese government does not want to support, into industries where they do want to support, like semiconductors and autonomous driving. And lastly, I want to show you some stocks that I do think potentially has some downside opportunities in this type of market condition. And the first one, and the one that I want to talk about here, is First Solar. This is a stock that has seen zero revenue growth here over the past few years. Over the past 4 quarters, we've actually seen revenue decline. We've also seen earnings decline here over the past couple of quarters, and very much kind of in a range-bound mode between 70 and 90 or 92.5 2.5 here. And right now we're near the upper bound of that range. So what I'm looking for is the type of price action that may continue this range bound near the upper bound of this range, and looking for a bounce towards the bottom end of this range. So the type of strategies that you would use is, again, limited risk strategies. Try to use limited risk strategies, such as selling a covered call if this is a stock that you own, selling a call credit spread if this is a stock that you don't own. Take advantage of the higher implied volatilities that the current markets are providing, and be able to use that to your advantage when you're trading options in this type of market condition. But I would stay away from shorting these types of stocks. We've all seen what can happen when you short stocks like GameStop or AMC. You want to stay away from shorting those stocks or any strategy that has unlimited risk if you're wrong on that short, and make sure that you protect yourself to the downside if this stock does continue to rally above its breakout. Because if it does break out here from this 92.5 range, it's headed back towards 110 or so. So you want to protect yourself against those moves if you believe that this is more likely to be range bound. If you look at the fundamentals, if you look at the technicals, that certainly is where my views are on this stock. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of the broader markets, what's moving and how I'm looking for opportunities here in this broader market. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here tomorrow afternoon on our options education session, where we do have a very special announcement of a new product that we are just launching here for Firstrade customers. With that, thank you so much. Have a great trading day.